In 2007, Warren Buffett launched a $1 million challenge on the famous Long Baits website. The bet was simple. Starting from January 1, 2008, over the next 10 years, the S&P 500 index would outperform the net returns of a portfolio of hedge fund funds. In other words, Buffett was challenging the entire hedge fund industry, or more broadly pitting passive investing against active management. He believed that while a fund manager might beat the market in the short term, say 1 or 2 years over a long enough timeline, the market would ultimately come out on top. Despite facing strong opposition from many prominent investors, no one initially dared to accept the challenge. After a long wait, one fund manager named Ted Sides stepped forward. He selected 5 hedge fund funds as his portfolio to go head-to-head against Buffett's choice, the Vanguard S&P 500 Index Fund, ticker VFIAX. This fund is almost identical to VOO, which we've introduced before. The only difference is that VOO is an ETF, while VFIAX is a mutual fund. Fast forward to 2017, who won? Hi everyone, and welcome back to Charlie's US Stock Channel. In our last 2 weekend videos, we introduced 2 essential long-term investing strategies: dollar cost averaging and value averaging. Now that we know how to invest, let us take a closer look at what we should invest in to build long-term wealth and improve our lives. Of course, this video is for educational purposes only and does not constitute investment advice. So let's dive in. Shortly after the challenge began, the market was rocked by one of the worst financial crises in modern history, the 2008 subprime mortgage meltdown. Buffett's index fund lost 37% that year. Meanwhile, the hedge funds, thanks to sophisticated risk hedging, only lost 23.9%. Just in the first year, Buffett's fund was already trailing by double digits. At that point, many thought Buffett had made a huge mistake. But what no one expected was that every year after that, Buffett's index fund consistently outperformed Sides' 5-fund portfolio. By 2015, Buffett's fund had caught up and overtaken the hedge fund portfolio, and the gap only widened from there. In 2016 alone, Buffett's index fund returned 11.9%, while Sides' portfolio returned just 0.9%. Eventually, Sides conceded. After 10 years, his portfolio had an average annual return of just 2.2%, generating $220,000 in profit. Meanwhile, Buffett's index fund returned an average of 7.1% per year, earning $850,000. Buffett credited his victory to 2 main reasons. First, in the long run, not even the best professional investors can beat the market consistently. A fund manager may get lucky in one particular year by picking the right stocks. But over time, beating the market becomes nearly impossible. So as long-term investors, our goal shouldn't be to outperform the market, but to grow with it. The second reason is management fees. Hedge funds typically charge the industry standard 2 and 20 fee structure, 2% management fee, plus 20% of profits. In contrast, Buffett's chosen index fund had an expense ratio of just 0.04%. That small percentage may not sound like much, but over time, compounded fees make a massive difference. Remember the numbers we just discussed? A 7.1% return versus 2.2% may not seem dramatic, but over 10 years, that difference led to 4 times more profit. Now imagine stretching that over 20 or even 30 years. This is the power of compounding and a key difference between short-term and long-term investing mindsets. In long-term investing, even small differences are magnified over time. So the 2 golden rules of long-term investing are: grow with the market, keep fees low, and index funds embody both of these principles, making them perhaps the most suitable investment vehicle for ordinary people. So what exactly is an index fund? Simply put, an index fund buys shares of every company in a particular index and bundles them into one investment. Take Buffett's example, the Vanguard S&P 500 Index Fund. The S&P 500 includes many of the world's most powerful companies: Apple, Microsoft, Amazon, you name it. and the man who created index funds. That would be John Bogle, the founder of Vanguard. In 1976, Bogle launched the first-ever index fund, a revolutionary concept at the time. Buffett once said this about him: "Jack Bogle has done more for the individual investor than anyone I know." Why? Because Buffett has repeatedly stated in his Berkshire Hathaway shareholder letters that for most people, the best way to build wealth is to simply invest in index funds. And Buffett didn't just say this, he acted on it. He told his wife that if anything ever happened to him, she should put 10% of her money into U.S. Treasuries and the remaining 90% into the S&P 500 index fund. So what makes index funds so compelling even for someone like Warren Buffett to skip individual stocks? To answer that, we can look at Bogle's investment philosophy from his writings. Here are two key takeaways. First, individual investors cannot beat the market consistently over the long run. Why? Because of something called mean reversion. Bogle believed that successful investing isn't about reading financial statement or mastering economic science. About understanding this simple idea. Mean reversion means that prices that are too high or too low will eventually move back toward the average. Let me give you a real-life example to make this less abstract. If you follow basketball, you know Steph Curry recently broke Ray Allen's all-time three-point record. He's the best shooter in NBA history. But say he has had a few off games lately, maybe due to pressure or fatigue, and his shooting percentage is down. If you're facing him in the next game, should you be relieved? Absolutely not, because odds are his performance will bounce back. That's mean reversion in action. Let's go back to the example of investing in stocks. In his book, John Bogle listed 8-star fund managers who had all delivered outstanding returns at some point. But over time, without exception, they all regressed to the mean. We often hear about some investor who has done incredibly well in recent years, then everyone rushes to copy their strategy. But just because they have done well doesn't mean they will continue to do well. Eventually, their returns will likely revert to the average. And this rule even applies to the legendary Warren Buffett. Buffett's performance over the past few decades was phenomenal. But in recent years, Berkshire Hathaway stock has actually lagged behind the overall market, another case of mean reversion at work. So if we know that, over the long run, investment returns tend to revert to the mean, the question is, how can we improve our investment returns? Well, since profit equals return, cost, and returns tend to revert to the mean, the only variable we can control is cost. So what kind of costs are we talking about in a fund? The most obvious is the management fee. Earlier, we mentioned the widely used 2-and-20 rule in the hedge fund industry: 2% management fee plus 20% of any profits. The more the fund earns, the more the manager takes. Sounds reasonable, right? But let's reframe it with a restaurant analogy. Imagine you go to a restaurant. The waiter tells you that a steak costs $20, no matter how it's cooked. If it's burnt, still $20, but if it's cooked just right, you have to pay an extra $100. Would you still order that steak? Most people would feel like the restaurant is taking advantage of them. This is the most important financial advice you'll ever receive. In our everyday life, most transactions follow a simple logic. Pay a fixed price, get a fixed value in return. If I pay $10 for a steak, I expect a delicious steak, not something overcooked or spoiled. The more I pay, the higher my expectations. There's another type of transaction, commission-based. Like when you hire a real estate agent, they only get paid after your house sells. Their income is less predictable, but if they perform well, they earn more. Most fund managers make between 2 and 20% annually, but that's just the visible cost. Most mutual funds have hidden costs, especially turnover costs. Because fund managers are actively managing your portfolio, they frequently buy and sell stocks. Every transaction has a cost: commissions, bid-ask spreads, and even the market impact of large trades. Before index funds were invented, the total annual cost, visible and hidden, could easily range between 3% to 4%. That might sound small, but it adds up fast. If you want to learn more about how to invest in index funds, you know what? Even I haven't always followed that advice. Despite knowing that actively managed funds come with higher fees, I still have some of my money in them. Why? Because my fund manager helps me connect with people from different industries. That's valuable networking, and second, it does give me peace of mind knowing that a professional is managing part of my money. I mean, when markets crash or stocks tumble, any investor is gonna second guess themselves. But when there's a professional involved, it's easier to trust their judgment. But here's the thing. Can you trust the judgment of someone who is only looking out for themselves? If you were Warren Buffett and the very first year of your $1 million challenge saw the market crash and your index fund fall far behind, would you have had the patience to stick with it? Long-term investing means trusting the data, trusting the numbers, and that can be really hard to do. But it's also true in life. If you're going through a rough patch right now, don't lose hope. Good things may be just around the corner. Your life, too, can revert to the mean. Before we wrap up, let me recommend the website I mentioned at the beginning. Long Baits is a fascinating project created by renowned author Kevin Kelly. You know, the guy who wrote Out of Control, a book that explores human society from a long-term systems perspective. In fact, the movie The Matrix 4, also known as The Matrix Resurrections, is said to be a tribute to that very book. To encourage more people to think long-term, Kevin Kelly founded Long Baits. It's a platform for public, high-stakes predictions about the future. The idea even caught the attention and financial support of Amazon founder Jeff Bezos. Today, with concepts like the metaverse and AI dominating headlines, we're constantly trying to guess where the future is heading. But maybe, instead of always looking forward in speculation, we should also look backward at how people in the past imagined the future. You'll realize something surprising. People almost always underestimate the power of time. We'll see you in the next video.